Welcome to this week's edition of Financing Foundations. On this week's edition, we're going to be talking about some interesting deals that we've had across the last couple of weeks. And as a team, kind of talk through them, the pitfalls, the good, the bad, the ugly. So firstly, we're going to move over to Raz.
So my interesting deal of the week, actually had quite a few, but the one that really stands out is I've got a client that is buying something around 35% below market value.
Can I have it?
Which doesn't actually happen, right? But it's a mixture of like commercial, resi, various other things, all in one title. What we were able to do is actually get a lender to lend against the market value as opposed to the purchase price. What we will also be doing is splitting all of the titles, so the commercial is separate to the resi, which means we can leverage up to a much higher loan to value. And what that means is we can actually get them pretty much 100% of the purchase price.
Yeah.
So that's it.
Would the lender go over 100% of the purchase price?
They'll go up to, I guess they've got a cap. So every lender has like two caps, your loan to values and also loan to purchase. Have I done that right?
Yeah, they'll go 75% of market value up to normally 100% of purchase price. But some will go, the couple of lenders that we obviously know about, some will go 100%, up to 100% net of touch. So it's very wise.
The gross might be like 105% or whatever
to take into account the interest if it's retained, right?
Yeah, exactly. But I mean, the clients were like super happy with getting 100% of purchase price. But yeah, there's obviously a possibility that we can get slightly higher as well if it's an actual below market value.
Well, this is it.
And that's the biggest thing.
Yeah, we've spoken about, this 100% funding strategy on some of our previous Instagram reels and bits and pieces. And I always get clients that come up to me going, it's all well and good that you're going to do this 100%, but where do I find a deal that's going to give me 30%, that's 30% of my market value?
Yeah.
So and interest, where do they find theirs? Because I'd like to know that source.
Yeah, so I think they've got it kind of below market, like off market, sorry.
Okay.
And they're like in the property business. So potentially something that's a little bit more like distress that's come to them. One of the lender's questions as well is like, why have they got this below market value? So you have to obviously have a strong narrative to support that. Just saying they're really good at negotiating doesn't have it.
And what was the reason on this one?
Pretty much that, but I don't necessarily want to give away their tips and tricks. But
sometimes it's probate that can...
Yeah, no, not in this case. In this case, it's one of those where it's a deal that they've come across off market
because they're in the industry and
because they're in the right place at the right time. I guess as well.
I've had a few of them, but I think sometimes the clients maybe say too much, and we've always found that valuers valuing it up as the...
I like what you're talking about, yeah.
So it's like lenders say one thing, valuers say another.
Yeah.
Which is another hard thing in the industry.
What, you don't want a client being there when the valuer goes out and then telling the valuer something different to what the lender understands the rationale to be why they've got it below market value, as an example.
Yeah, like at one example, a 4-unit block in Surrey, similar scenario, below market value. Client met the valuer, and the valuer said, "How much are you buying it for?" Client told him miraculously it was off market. There was no other evidence of that property anywhere, and the valuer valued it exactly what the client had miraculously told him.
Yeah,
so it's like that's just the valuer covering their own backside.
Because
which is frustrating.
Certain lenders won't actually tell the valuer what their purchase price was because they wanted to value it at the market value. So it's just keeping that away from them.
Yeah, definitely. And which is why you can't do auctions, because it just doesn't work.
Yeah.
On your one as well, I take it you reverse engineered that, because if you're going to be splitting the titles, you'll want to be making sure that you've got a commercial term exit lender on the commercial element as well, right?
Yeah, exactly. So it was not only do we want to get the first element where they've got 100% funding towards a purchase price, we also want to make sure that when they're able to exit, they've done their refurbs, they've got the title split, then on the back end of it, they can get maximum leverage on the terms. And we've also got lenders in mind that we can kind of put them to, and they're still pulling money out even at that stage.
Nice.
Yes.
Yeah.
So overall, it's a great deal. I wish we could come across them all the time.
Nice, I like that.
So one of the main takeaways is, it sounds a bit manipulating, but make sure the lender is instructing the valuer in the right way to get a true and accurate market value, not just get valued as a purchase price, and try and make sure the borrower's not meeting the value up and blurting stuff out that you almost don't want blurred out.
100%. And then obviously reverse engineering to make sure that they can get the exit on the commercial term and the resi term as well at the right loan to values that are going to make the deal worthwhile and put as much money out as they can.
Yes, exactly.
Nice.
Yeah.
Nice.
Decent.
What about you, Joseph? What's your deal of the week, or most interesting one anyway?
The most interesting one, we've had a few similar scenarios. It's more a strategy, but we've got a couple of lenders who will almost like split the bill cost on a development loan. So we've got a couple of deals that we're trying to essentially get maximum leverage for at the minute, but without giving away equity. So getting one lender to fund the build and as much as we can towards the purchase price. And we've got a strategy with one lender where they're essentially allowing the borrower to get to practical completion, which would mean that the overall units are finished, they're all signed off by building the drill, etc. And any works on that site that happen post practical completion can be essentially removed from the build cost. So it means that the net day one figure, the contribution towards the purchase price from the lender's perspective is higher, and the lender has got a separate facility in the background, which means once they hit practical completion, they'll do like what's called a development exit loan, which is at higher leverage anyway because the risk is reduced. So that's quite a cool structure that I found has been quite interesting. And the example is 9 units in Essex, where around 250 grand of the works was post practical completion. So the lenders reduced the build facility by 250 grand. The developer knows that they can get to practical completion, they're not cutting themselves short, and the lender knows the plan. So we're going to get to practical completion and then almost do a refinance with the same lender, same funding line, but on a development exit product, because the risk is reduced because the site's built. And that remaining 250 grand will follow post completion. So it's a really weird strategy. We'll see a lot of lenders find ground up, especially quite risky throughout the whole build. So once you hit practical completion and you've got a tangible asset that can be sold,
Opens up the floodgates a little bit.
so that's quite an interesting strategy. Like, not every lender's doing it, and it's quite hard to manage that with monitoring, surveillance and stuff. So you need the lender fully on board, like really commercially savvy, and their funding lines to also understand it rather than getting to completion and the funding line says no, it's not, doesn't feel comfortable. So that is an interesting strategy that I'm working on a minute with a project.
Nice. And do you think if you'd known that strategy before, do you think that would have worked on any previous developments? That's always a question that I like to know, 'cause it's always frustrating finding a new funding strategy or lender that would have done something though where you couldn't find a solution before.
Potentially, yeah. I think the landscape's changing though. Like a lot more lenders, like we've seen a lot more lenders competing over deals.
Yeah.
I think we've all experienced that, where they want to get money out the door, whereas maybe last year it wasn't as strong, or like GDVs were a little bit more volatile, construction costs were a bit more volatile, base rate was more volatile, and now things are not settling, but there's some parts of that what like lenders ultimately need to lend money, and the strategies are slowly evolving. So I'm not saying it's going to be a big strategy, but in answer to your question, there probably was some scenarios that could have been funded in that way. But in a tough market, which this is to some extent, we're always looking at different ways. Like we have a lot of borrowers come to us, as we all know, asking for the equity contribution. So if you've got very little cash, you're looking to raise the debt and the equity piece. This is a way to like reduce that equity needed. So that example, the client's got like 500k to put into this project. But if we remove 250 grand of the bill cost, his cash drops from 500 to 250. So he's halved his cash that goes into the deal. So his return on capital was huge, but he's still able to finish the project in that way. Whereas before, we would have probably just been trying to get an equity ticket for that 250 grand, and the client would have given a bit of profit share away to get that. So yeah,
nice. And I guess that's the commercially savvy like lender that's switched on, that understands like during the build as well, like costs can go up, like various things can change, and that's happened a lot right now. So I wonder if that kind of tweak and change in strategy has happened because they see the landscape change.
Maybe,
as well.
Yeah, I think it's funding lines as well, right? We know a lot of lenders are funded in the same way with institutional funders, and then funders aren't developers. I'm not going to say any names, but like big, like multi-billion pound hedge funds that are funding some smaller lenders in the UK. But when you get like a small family office with their own fund, or they're a principal lender rather than relying on institutional funders, I think that's where the the strategy can change.
Yeah.
Yeah.
That's
Yeah.
the difference, isn't it? So yes, that's one of my kind of exciting, interesting strategies that we're actively using on a deal at the moment.
Okay.
So
Nice.
Nice. So for me, bit of a weird one for me actually, something I actually haven't done before, which was a third-party cross-charge. We've obviously seen a couple of lenders that will now do this, and for people watching, if you don't know what a third-party cross-charge, that's where you can actually utilize a friend or family member's property as long as they've got equity, enough equity below, and below more than 30% equity in a property, they can use anything under 70%, up to 70% worth of debt. That was really confusing. But so I had a client come to me. He was buying a property for about 100k, refurbishment like 25k. GDV though was 220k. So it was a decent deal, but the client had about $7,000 of his own money, which we obviously know we all get some people that have got, not much money in their pocket. However, this client had the opportunity to use his parents' home where they only had 50% debt on it.
Right.
So he could use up to another 20% as a third-party cross-charge. He would be the only person on the application for the property that he was buying. And all they would have to do is sign some level of paperwork to sign that they're happy to give away some of their equity towards his property that purchase. And actually what we obviously had to do is reverse engineer it and make sure that when he refinanced off, is that 70% of the new value after he's done the refurb covered the total gross amount that he was borrowing, including his the loan from the lender and also the equity that he was borrowing from the parents' house.
Perfect. So at refinance, they can basically pay back their parents and also clear the bridge.
Yeah, so the lender's loan will be 75% as an example against the money he's buying, and then however much capital he needs will be a third-party cross-charge against parents' home. So yes,
Nice.
that we had to make sure that 75% of the new value, once he'd done the refurb, would cover paying off the loan from the lender, 75%, plus any equity on the parents' property that he borrowed as part of that loan as well.
So I think that's interesting. Both yours and Raz's and the deal I just spoke about, actually, it all comes down to the exit.
Yeah.
So where people are really excited to get their first deal and they're trying to force something, that strategy doesn't work, because if you're forcing it too much, you're probably over-egging the GDV, under-egging the build, and at some point the valuer and the monitoring surveyor on that project you're buying are going to kill it and say there's no margin in it.
Correct.
Or if it does fly through, when they refinance, the money secured against mum or dad's property or whoever it is won't be redeemed. So actually,
Yeah.
the most important thing is the exit.
Yeah.
Yeah, making sure GDVs are actually what
But a
they
lot
are.
of things about exit when they're pumped because they've been to this property education course and they're like, oh, I'm buzzing to do my first deal, and then
100% money, no money down, no money down deal.
which they do exist, but you got to be smart with it.
Yeah. And we can, like we said, we can get 100% funding deals.
Yeah.
As long as everything stacks, and that's why we reverse engineer everything, right?
Yeah. And that's the thing, reverse engineering it, like making sure, firstly, like the exit stacks up, but also we're controlling so many elements there throughout the process. So it's not just knowing which lender can do 100% of market value. It's also then working backwards, making sure then the conversations with the valuer and making sure like this has happened. So there's so much more that goes into it to get those kind of shiny deals to work.
He sounds really, really arrogant. There's a lot of brokers that chuck rubbish at a wall and hope something sticks. But like your conversation this morning, speaking to a valuer, understanding, like loads of lenders say they do HMO value, like they lend on HMOs, but the nitty gritty detail is how you're instructing the valuer. Are you telling them the value on a below market value transaction? Are you doing a commercial val? But speaking to the valuer up front, who will either say yes, we'll do it, no, we won't. Obviously, you're not going to get exact details. That's super important. Appraising the deal before it goes to a lender, super important, and managing the exit. There's so many brokers don't do that.
100%. Yeah.
They just go, let's go and get lenders' terms, and then lenders' terms that are indicative terms that have been put together in 30 seconds from a lender. Sometimes, not all the time, sometimes are not
And all other brokers, like in that scenario that you're talking about, all those other brokers are doing is increasing the possible chance of non-success, increasing the possible chance of failure on every single deal.
Yeah.
And that's not good.
This is true.
This is why we're so successful.
It's becoming an hour thing.
It's all good. It's all good.
A good week of deals.
The week of deals, interesting deals, but they were our interesting deals of the week. I hope you've all found something useful and some good takeaways. Join us again next time for some other interesting topics. Thanks very much.